Got you. All right, so boom. So the credit is basically like free money. So like, I can spend as much as I want. Like, I ain't gotta pay them back, right?
So you ain't just listening to nothing I just said?
What's up? It's your boy Ace, and in today's topic we will be discussing the fundamentals of credit, debunking some lies and misconceptions, as well as speaking on how you can get started on building your credit now.
Oh, you mean right now?
Like right now. Yes, now.
If you are new to the channel, welcome. Shalom. Here at Ace Estate, we teach you the financial finesse, how to save and invest so that your life ain't a mess. If you get any value out of this video, make sure you leave a like, as well as leave a comment down below and subscribe. And with that out the way, let's get to this money. So before we even get into the nitty gritty, I can hear y'all right now.
But Ace, my uncle, mother, baby, cousin told me that credit was bad and that I should avoid it at all costs.
And I'm well aware that your grandmama and them told you that credit and debt is a scam and that it's evil and that's the literal spawn of Satan. I know, because I was told these same things growing up as well. That wasn't until I began to study and research credit myself and found out how it really works. All right, so peep game, right, y'all? So the standard definition of credit is the ability of a consumer to receive goods and services prior to payment based off of the trust that they will make a payment in the future. So at its core, credit is about trust. If I lend you $5 and you give me your word that you will pay me back that $5 next week, I have no problem giving you the money because I trust and believe that you will pay me back. Damn near everything in our society runs off of credit, from the real estate market to purchasing a vehicle to even getting that new iPhone. While it is possible for you to be able to live 100% debt free and to pay cash for everything, if you would like to accelerate your path to financial freedom and wealth, it is 100% crucial that you learn how to manage as well as leverage debt. If you don't believe me, imagine how long it would take if you had to save up to be able to buy a $100,000 house cash, or how long it would even take you to save up to get a $20,000 car if you couldn't get a mortgage or get a car note. Although credit is fundamentally just trust, banks and other financial institutions can't just take every applicant's word at face value.
Else they go bankrupt.
So they have to utilize what's called credit scores to be able to get a snapshot and an overview of a borrower's overall history with money. In a book entitled The 48 Laws of Power by Robert Greene, the fifth law in the book speaks about how much of our lives depend on our reputations. To give a direct quote from the book very quickly:
Reputation is the cornerstone of power. And as they say, it inevitably precedes you. And if it inspires respect, a lot of your work is done for you before you step on the scene or even utter a single word.
If credit is trust, then your credit score is your business credibility or reputation. And just like in the office or in the streets, you must guard it with your life. If your credibility or your reputation is good, then people show you love and you get treated with the utmost respect. However, if it is bad, then people treat you with little or no respect and they don't want to deal with you or associate with you. And in the financial or business world, that means being denied credit or being charged ungodly amounts of interest to be given access to credit. Your credit score ranges from between 300 to 850, with a good score being considered upwards of 680 to about 720, and the best rates and the ideal score ranging between 760 to 850. The score is calculated by a data analytics company called the Fair Isaac Company, which is where the term FICO or FICO score comes from. And your score is calculated and determined by your consumer credit report. It is the job of the three credit bureaus, Equifax, Experian, and TransUnion, to gather, collect, maintain, and deliver this information to FICO so that they can calculate the scores. Since each one of the three credit bureaus work independently of each other and they all collect slightly different information, you technically actually have three credit scores. To determine your FICO score, you must find your middle credit score. So your middle credit score is the number that is in between the highest and lowest score that you have. So for example, if you have a score of 720, 700, and 680, your FICO score or your middle credit score would be considered to 700. But now that we got some of the basics out the way, let's get to the meat of your credit profile and start speaking about how you can actually start building your credit today. If I've been holding your attention so far, you should definitely give me that like I was talking about earlier. And also,
I hope that you know that I can see you.
You not low. You ain't subscribed yet. You know that I can see you, right? So there are two types of credit, secured and unsecured. Secured credit requires you as the borrower to put up some type of collateral, whether that be a house or some type of other asset worth of value in order for you to receive the credit. Unsecured credit, on the other hand, requires you as the borrower to put up no collateral, and it's just given to you based off of the strength of the relationship that you have with the bank and or your credit profile. The easiest way to start building your credit is to start with the bank or credit union that you already have an account with. Simply walk into the local branch.
Well, since we're coming off of Rona, it might be better to just call or go online.
But go into the branch or go into the bank and tell them that you would like to apply for and open an unsecured credit card or line of credit. Whichever bank you go to should have some type of credit available, if not a wide variety and assortment of different cards. And once you choose one, all you have to do then is give them some basic financial information, such as how much you work and where you work at, and then they will submit your application for your credit, which will either be approved or denied. If you're approved, congratulations. But if you are denied, you have a few other options. You could either A, go to another bank and try to get approved for another unsecured line of credit, or you could simply go to the same bank and you could apply for a secured line of credit.
I don't know, Ace. Don't you got already have money and stuff to build your credit?
If you caught last week's video on effective ways that you could be spending your $1,200 stimulus check, then instead of taking the $120 to pay off any high interest debt you have, since you don't have any to begin with, you could take that $120 plus the $140 from your self-improvement and use that as a combined $260 for you to be able to get approved for your first secured line of credit. All the bank is going to do is they will take this money and they will sit in an account for you. It is not going anywhere. You don't have to spend any money. It's not going anywhere. I promise. They will take the money and they will put it in an account for you. And after 4 to 6 months, you will get the money back. Your credit will be switched over to unsecured and you will be receiving an increase. All you have to do is use the card as you would your debit card or cash. Put the same regular minor expenses that you would put on your debit card and pay it off.
Got you. All right, so boom. So the credit is basically like free money. So like, I can spend as much as I want. Like, I ain't got to pay them back, right?
So you ain't just listening to nothing I just said?
There are a total of 5 factors or categories that make up your credit score. And the crazy thing is the 2 biggest stumbling blocks for people happen to also be the 2 largest ones. So the first one is your utilization rate. Your utilization rate is the amount of credit that you use versus the amount that you have available to you. While under normal circumstances, it's no one's business how much money you are making or spending. It is the bank's business because technically you're using their money. Contrary to popular belief, banks actually like to give money to people who are financially stable who don't actually need it. The reason why is because every single dollar of credit that you spend is a potential loss to that lender if you decide to run off on the plug twice. Put the joint in. If you want a simple rule of thumb of how much of your credit you should use versus that you shouldn't use, take whatever your balance is, take that number and just divide it by 3. Divide that number by 3 and do not go over that. It's as simple as that. Take that number, divide it by 3, and you done. Now in regards to your payments, as we established earlier about credit being trust, you have to make the payments on time, and preferably you need to make the payments in full every time.
But like, don't you gotta carry a balance so like your score it go up and stuff? Like,
while it's fine to carry a balance and pay a little bit of interest, if you can't pay off the balance in full every month, you absolutely do not have to carry a balance on your card in order for your credit score to improve. You do not have to whatsoever. Simply set up automatic pay. If you set up automatic pay, the money for the minimum will come out every single time. So you can either pay it in full every month or at the very bare minimum, set up that you make the automatic minimum payment and you will be fine. Okay? So we got the first two of the 5 major factors out the way, being your utilization rate and your on-time payments. The third of the factors that impact your credit score is your length of credit history. Since credit represents your borrower and money history, the longer your reputation, the more likely banks are to extend larger amounts of loans as well as credit lines to you, and the more that they trust you. Last but certainly not least, the fifth and final factor that impacts your credit score is your credit inquiries. So a credit inquiry is when a credit-based institution, i.e. a bank or an individual, pulls or looks up their credit in order to qualify you or approve you for a new loan or a new line of credit. There are 2 types of inquiries. There are soft inquiries and there are hard inquiries. The easiest way for me to define them is that soft inquiries are informative, hard inquiries are active.
But I thought don't looking up your score make it go down or something? Like I thought looking up my score was bad. Isn't looking up your score bad?
I never really understood where this misconception came from, to be honest with you. You need to know your score in order for you to apply for and get approved for loans as well as other types of credit. So why would the credit bureaus negatively impact you for looking it up? It never really made sense to me, to be honest with you. If you are getting a soft inquiry is when you look up your credit score yourself. It's for informational purposes. You are not actively applying for anything. You are not actively doing anything. All you are simply doing is you are looking up what your score is. Another example of a soft inquiry is when credit card companies send you promotional cards. This does not negatively impact your score at all. It has no impact on your score whatsoever. So you do not have to worry about that negatively impacting your score. The type of inquiry that does impact your score, however, are hard inquiries. Hard inquiries are when you are actively applying for and utilizing your credit to be able to get access to some type of funds or some type of loan. So when you go into a bank to apply for a new credit card or to apply for a mortgage or to apply for an auto loan, the credit lender or the bank that you are at will pull or look up your credit so that they can qualify you and approve you or deny you for the loan. This does negatively impact your score, but it normally only drops it by a few points for a couple months, so it's not that big of a deal. And thank you, ladies and gentlemen, for watching. If you got any value out of this video, make sure you leave a like as well as comment and subscribe. Check out some of the links that I have below if you would like to support, and I will see you guys in next week's video for Wealth Wednesday. Yeah.